Okay, now that we're back, or at least some of us back, we seem to have lost the back rows. Although there are a few bags there, so I'm confident they'll come back. The break just finished.
Oh, no, the door's locked.
Oh, the door's locked. Well, I apologise, that was... I wonder what... Anyway, I wonder what that door does. Can you chuck... Is there any way you can chuck something in it? Bugger it. Okay, so you can't see the screen. I better change it. Okay, so welcome back. Turning now to long-term or other long-term employee benefits. Long service leave, sabbatical leave, jubilee. I've never heard of jubilee benefits apart from in the standard, so I have no idea what they are. Long-term disability benefits. The one we're going to focus on is long service leave. The amount recognised as a liability for other long-term employee benefits shall be the net total of the following amounts: present value of the defined benefit obligation minus the fair value of plan assets if there are any. Now, for long service leave, there are no plan assets. Long service leave is simply you've been there long enough that you've earned long service leave. So when they're talking about the defined benefit obligation, it's defined because the benefit that you get is based on your salary. So if I want, could take long service leave at the end of the semester. And the amount of money that I would get, so the leave I'd get would be based on how long I've worked, multiplied by what my salary is. So the salary is an important component of that. The present value is an important aspect, so we'll look at that as we get into the detail of the demo question. What else is important? Now, the reason we look at long service leave as a practical question is not because it's one of the biggest ticket amounts on a balance sheet, and it isn't. If you look at an annual report, long service leave really doesn't equate to that much. One of the reasons we include it in here is because, in a way, it's an easy way just to start to get an idea of how the present value of the defined benefit obligation is calculated. It just gives you a bit of sense of how this works, which is kind of similar when you think about what superannuation is. They're looking at comparing present value of the defined benefit obligation and plan assets. So we thought this is just an easier way to look at it. You recognise it as an expense unless otherwise required to include it in an asset. So generally we're going to see debit expense, credit liability. The issue for us is how much. And we'll get to that just after we cover termination benefits. Now, this looks like it's changed a little bit, but termination benefits. Now, these are sort of things where a company goes through a restructure, and often when a company goes through a restructure, a whole bunch of people get fired because they get restructured out of a job. I was actually reading the other week of a woman who is suing her company. I think it might have been over sexual harassment, and I don't know the merits of the case, but part of, like, she lost her job, and she lost her job in a restructuring. Now, she thinks that she's been hard done by that, and based on just a little bit I read, probably is warranted, because in that restructuring, the only two people lost their job. She did, and her personal assistant did. No one else in that restructure lost their jobs. So I mean, you would have thought the company probably didn't go about it quite the right way. But anyway, I don't know what's happened with that case. But when you've got a restructuring, often people lose their jobs, but potentially get offered redundancy packages as that restructure happens. Or it could just literally be they're trying to get rid of people. It happened up at Sydney Uni not that long ago. A whole bunch of people were offered redundancy packages because they had to cut staff numbers because they had some building work and there were cost overruns and they needed to get money, and they were losing money, so they needed to find some spare money around the place. Given the amount of building that's going on at UTS and how much potential overruns are, I don't know. Hope my job's safe. Anyway, when you recognise that is, you recognise a liability and expense for termination benefits at the earlier of when the entity can no longer withdraw the offer, or when the entity recognises costs for a restructuring within 137 and involves payment of termination benefits. Para 166, earlier of when an employee accepts or there's a restriction preventing offer being withdrawn. So if you think about the framework, it's almost like, when is the company definitely going to have to pay something out? Until that point, like if they just say, oh, you know, maybe we're offering something, but people don't have to take it up, then you wouldn't have anything coming on there. It's when there is an obligation that they are going to have to do something. Measurement for termination benefits. Basically, if it's within 12 months, you don't discount. If it's longer than 12 months,